Welcome back, guys, to another exciting episode. So today I'm going to be explaining a couple of terms. I know these terms are very, very dear to traders, especially if you really are serious about your trading. Whether you're a beginner or you're someone who has been trading for a very long time, you would need to know how to calculate your margin. You need to know how to calculate, required margin, used margin. And also, if you stick around long enough, I am going to show you this exciting tool, which is calculator, right? So it's just a tool that helps you calculate the required margin of how much you're supposed to deposit into an account if you want to trade a particular lot size. And what is the maximum lot size you can open on a particular type of account or asset or pair. And then there's the leverage calculator as well. So it can help you calculate leverage. It also helps you calculate the maximum number of trades that you can open in a particular, um, particular lot size, right? And also here it helps you to calculate the amount of profit that you would get per pip of a particular asset. So stick around. I'm going to share this free tool, but in the meantime, allow me to explain some of these things, which are leverage, margin, and how they are calculated and why they exist in the first place in the Forex trading space. All right. So without wasting much more time, let me present this particular uh, video. Okay, so let's start off by defining leverage. Now, if you have traded for a long time, you would know that leverage is actually um, a derived word, right? And it is derived from the word lever, right? So a lever helps you to lift heavy objects by applying less force over a longer distance. Now, so leverage really implies that you are putting very little effort to lift a big load, right? And let's give an example of leverage in a purchase of a house. Let's say you want to buy a house. You could approach a bank and let's say you want to buy a $10 million house. The bank will say to you, can you deposit 1 million and we'll cover the 90% in debt. So the bank will give you 90% of the funding as debt, and then you will pay your 10% as equity, right? And then when you finance this, what it means is that there is a 1:10 leverage. Your $1 has managed to buy you something that is worth $10, or your 1 million has managed to buy you what is worth 10 million. And it doesn't necessarily mean, especially for Forex, doesn't mean you have to pay back. Uh, I will explain to you know to some of you guys later on what it actually means and how brokers actually make their money off of this, especially with the leverage being something that they are giving to you. Um, then the question would be, how would they be making money? So we'll talk about that a little bit later. But in the meantime, let's talk about the definition of leverage. So in Forex trading terms, traders actually borrow funds from brokers so that they can trade larger positions of a currency. Forgive my spelling there, that's supposed to be a Y. So why would leverage exist? So let's talk about a normal transaction in Forex without leverage and how that differs with a leveraged transaction. So let's say you have $1,100 in your pocket and you feel like I want to invest in Forex trading, right? Or I want to trade currencies. Then you go and buy $1,100 worth of euros at the rate 1.1000. Okay. Which means at that particular rate, you are going to buy 1,000 euros. Right. After buying 1,000 euros, and then in a day, let's say the rate changes from 1.100 to 1.1050, which is a 50 pip movement. So we'll define pip in another video, or you can look up the definition of a pip. Now, when that exchange rate does that, right, and you sell your euro, you have 1,000 euro, and if you sell it, you get $11,005. Your profit for this particular transaction for the whole day is $5. And we are not even considering the cost that it took for you to actually get into this particular trade. So if you're going to approach a broker, they charge what is known as spread, which is the difference between the ask price and the bid price. And therefore, you are going to make a loss because you're going to be charged for this conversion. So instead of making a profit of $5, probably your profit would be $1 or $2. Now, consider now a leverage of 1 to 500, which means $1 of yours buys you $500 worth of currency. If you have $1,100, but that $1,100 is now worth $550,000 because of the leverage, you buy 550,000 worth of euros at that rate, the same exchange rate as before, and that will give you 500,000 euros. Now, in one day, if the exchange rate moves the same way, which is 50 pips to 1.1050, you will sell your euro and get $552,500. That is an actual profit of 2,500 for a 50 pip movement, and you started off with $1,000. So this is why Forex trading is lucrative, because you can start off with a very small amount of money, and because of leverage, you can actually get to trade with more power, right? So what would happen if there wasn't any leverage? Of course, only institutions and high net worth individuals would trade. So because there is need for there to be more volume on the market, the brokers introduce leverage so as to pull in as many individual traders as they could. All right. Now, the Forex market wouldn't be worth the while, even for the high institution traders, if there were no leverage. Because realize that if you were going to toil the entire day for $1, that wouldn't be worthwhile. You know, if there's other investments that could actually earn you more, you would prefer to the next best alternative. All right. So then it would also take too long to gain a meaningful return if there were no leverage. And it also improves your buying power, your purchasing power. That's a nice joke over there. You can tell that I got this template from Canva there. All right. So now let's talk about margin. A lot of traders now then are like, okay, so I understand what leverage is now, but then I always see my account saying margin, free margin, and all of that. Now, I want you to imagine you go into an ice cream shop, right? Now, let's say you have $3 and each ice cream costs $1. Now, you have $3, that is your equity, so that's how much you have. Then when you get into the ice cream shop, you buy an ice cream. But here's the twist. Say you are given a time frame which you could actually exchange your ice cream flavor for a different one if you haven't ate it, right? So if you buy one ice cream, you have used that margin. It is no longer available for you, right? Unless you return that ice cream, that particular dollar is tied up, okay? So used margin represents the money that is tied up in a transaction. It is money that you can't use unless you close that particular trade, right? And then free margin refers to the amount of money that you can still use to buy two ice creams. Now, of course, if you're going to look at your equity on the, in terms of money, you still have $3 in terms of equity. Why? Because you have $1 worth of ice cream and you've got $2 in your pocket. So your equity represents everything you have, but doesn't necessarily mean you can use all of it to enter into a new trade. You can only use the free margin, which is the $2. So this one is already tied up because you already bought an ice cream, and this one is not uh, tied up. You can still get two ice creams from that. Okay. So I hope this clears up the used margin and the free margin versus equity argument that most traders have. And this is the exact reason why if you put in all of your $3 and you're now holding three ice creams, regardless of the fact that you still see that you're worth $3, you can no longer buy any new ice cream. That's why MetaTrader or whatever trading platform will say no money or no, not enough money. You won't have enough money to buy a new ice cream. You would need to return one ice cream and then get a different flavor. All right, I hope this explains it, guys. I try to make this as simple as possible by using an ice cream scenario. Okay. Okay. And I wanted to talk about a margin call, but I forgot to put the slide over here. So then let's say you let your ice cream melt, right? So say you bought this ice cream and you bought all three ice creams, right? And then they are melting. At some point, you will not be able to return these ice creams back. You are stuck with them. At that point, you no longer have value. Okay, whatever you're holding no longer has value. It's no longer worth 100% of what you had. That's when your account starts to turn red. That is known as a margin call. In fact, in former times, they would actually call you to say your account is about to blow. Please close one position or close two positions so that you can at least breathe, right? So that is what we call a margin call. And then as soon as you can no longer now return anything, it's now worthless, then you have what is known as a stop out, right? So essentially you've used up all your money. Even if you wanted more ice cream, you couldn't get more ice cream. In fact, you no longer have an ice cream because your ice cream has entirely melted. So you no longer have anything in your account to sustain the trade, and therefore the broker closes you out of your own trade. This is where you get people searching this forex trading scam, right? Because they don't know what a stop out is. All right, so let me just talk about this free tool that can be used to calculate margin and all of this. Now, before I show you the free tool, let me show you the formula for calculating margin, right? So the margin required to open a position, so margin required equal to contract size. We will learn all of this as soon as we turn over to the next page, times exchange rate. Right, so if you are trading Euro USD, you have to put the Euro USD exchange rate there, then times the lot size that you want to open, divided by the leverage. This will tell you how much money you need to deposit in a trading account so as to open that particular lot size if you have a certain leverage on your account. Okay, so allow me now to share my calculator, right, which is soon to be your calculator. All right. Yep. So let me show you here. Now this is the calculator that I've developed. Let me clear this off. So this is the calculator that I've developed. Very easy to use item, not too difficult. Now what it does, it helps you calculate the required margin to open a particular trade. So say I've got an account that has a leverage of 100, right? And the standard lot, okay? So when it says standard lot here, one standard lot simply means $100,000 worth of currency, right? If you have a trading account that has a mini lot or micro lot thing, mini lot is 10,000, micro lot is 1,000. But we're going to use a standard lot, which is 100,000. And say we have Euro USD. So I'm going to check the rate for Euro USD currently and see how much that is. Euro USD is 1.08814. Okay, so that's what I'm going to put for my exchange rate. 1.08814. So if I want to open a trade of lot size 1, the calculator tells me that should take up about $1,088. So it means the minimum balance I need to have in order to open a trade that has a lot size of 1 is $1,088. So let me test that theory, right? $1,088. Let me go to Euro USD. And let me try opening a trade of 1 lot to buy. Okay, as you can see here, it says margin 1088.14, which means I have used up $1,088 to open this trade, and what is free of my money is 14,000 minus 1,088, which is that's my free margin, right? And of course, there's other calculations that you may need to do. For example, what is the maximum lot size you can open for a certain account balance? So let's say you have a $2,000 account, and you have a leverage of 1,000, and the standard lot is that. So the exchange rate is 1.0881. That means I can open maximum of 1.84 lots on this account. So as you can see, there's a lot of work done here in the terms of the calculation. If you guys really see, I'm trying to give you some tools, guys. So your subscribe wouldn't hurt at this point. And I did put a couple of definitions in this free tool as well. Definitions of leverage, margin, required margin, and all of the other stuff that you want to know about. Pretty sure you see it's there. And then also this is a very important tool as well. I put this particular calculation here about if you lose a certain percentage of your account, you will need to make back what percentage of the new account to go back to your initial starting capital. So say you started at $100 and you lose $50. That's 50% of your account, right? So you will need to make 100% of the new account, which is the $50 one, for you to be actually back at your 100, right? So this will help you to understand why taking big risks is not really worth it, right? It is worth it if you can generate thrice the deposit or thrice the amount that you have deposited outside of trading. Otherwise, don't trade full margin, all right? And also, just a side note, right? A lot of traders don't actually admit failure. They continue depositing money, they continue losing money, and then they don't admit that, at some point you need to find someone who knows more than you. Right? And they will prefer to donate to the market instead of paying someone to help them learn, which is something that baffles me to some degree, because there is no other place, nowhere else, where people are actually looking for free money except for trading, where they don't feel like they could be trained to trade, right? So they will donate thousands to the market and cry about paying $100 to a mentor, 200, $500 to a mentor. So this is just a side note, just to remind yourself that you shouldn't admit failure. You should admit failure and you shouldn't be proud. If you feel like you need to up your game, find someone that knows a little bit more than you. Okay, it's not painful to do that. All right, so I understand that I will be wasting much of your time, so I'll continue talking about this. Um, just feel free, guys, to contact me. I put my email in the description. If you have got any questions about anything at all, just feel free to hit me up and I will be there to respond to you. Otherwise, all the best in the trading. This is yours truly. See you next time.